macro currency signals.
You won't believe what silver's about to do. That sounds dramatic. It sounds exaggerated. It sounds like one of those headlines designed to grab your attention and pull you into something unrealistic. But what if the real shock isn't that silver could move higher? What if the real shock is how normal that move would be when you step back and look at history? Right now, most people are trapped in the day-to-day price action. They stare at the screen, they watch $1 up, $2 down. They measure success and failure in weekly candles. And that narrow lens quietly destroys perspective, because when you compress your vision into the immediate present, everything large feels impossible. If someone told you silver was going to $1,000 tomorrow, you would laugh. If someone said next month, you would roll your eyes. Even next year sounds extreme, but stretch the timeline out. 5 years, 10 years. Suddenly the conversation changes. Suddenly it's not about fantasy, it's about cycles. Before we go any further, if this perspective is connecting with you, make sure you're subscribed and notifications are switched on. In moments like this, timing isn't just helpful, it's the advantage. Being early almost never feels comfortable. It rarely feels validated, but that discomfort is usually where the greatest asymmetry lives. Drop a comment below and let me know where you're watching from and what time it is on your side of the world. This isn't a local story tied to one nation, one currency, or one exchange. It's a global shift. And when you start seeing how far and how fast this signal is spreading, you realize this is much bigger than a single headline or short-term move. Now, let's get back to what just changed beneath the surface. History doesn't move in straight lines. It moves in long arcs of excess and correction. It moves in waves of optimism and pessimism. It moves through periods where paper assets dominate everything, and then periods where tangible assets reassert their role. And silver, more than almost any other asset, lives at the intersection of those extremes. Think about how quickly perceptions can shift. There was a time when silver sat forgotten, barely discussed, barely respected. Then momentum appeared. Prices doubled, tripled. People who ignored it started paying attention. That shift alone proves how powerful sentiment is, but sentiment is only half the equation. The deeper story lies in ratios. Ratios compress psychology, policy, debt, and valuation into a single number. They strip away noise and show you relationships. And relationships are what matter in cycles. One of those relationships is between major equity markets and gold. When stocks are wildly overvalued compared to gold, confidence is extreme. When that ratio collapses, it marks a transition. Not overnight, not in panic headlines, but gradually, structurally. Another relationship is between gold and silver themselves. Silver is a much smaller market. That matters, because smaller markets don't move gently. They move violently when capital flows into them. They overshoot on the upside just as brutally as they overshoot on the downside. When these ratios sit at extremes, history shows they don't just drift back to average. They swing, they snap back, they overshoot. And that's where the possibility of something extraordinary begins to look ordinary. Imagine a world where gold continues repricing higher over several years. Not because of hype, not because of social media excitement, but because debt expands faster than productivity. Because currencies weaken gradually. Because confidence in long-term purchasing power erodes silently. In that environment, gold doesn't need to spike, it just needs to grind higher, steadily, methodically, relentlessly. Now add the second force, silver compressing its ratio against gold. Historically, when precious metals bull markets mature, silver accelerates late in the cycle. It doesn't lead early, it explodes late. And because silver is small, because liquidity is thin compared to larger markets, the percentage moves become dramatic. Not unusual, not magical, just structural. People hear 4 digits and freeze, but they don't calculate what happens when 2 major ratios shift at the same time. They don't consider the compounding effect. If gold were to move several multiples higher over a long cycle, and silver were to reclaim a much tighter historical ratio to gold, the math becomes mechanical. It stops being emotional. It becomes arithmetic. The real danger isn't believing silver can move. The real danger is believing that the current system is static. That debt will stabilize itself. That purchasing power erosion will pause permanently. That cycles have ended. History suggests otherwise. There have been periods when deflation reduced debt burdens. There have been periods when inflation destroyed the real value of debt. Different mechanisms, same result, a reset in ratios. Today, debt levels globally are far larger than in previous decades. Monetary expansion is no longer a temporary tool. It has become structural. Liquidity injections are no longer emergency responses. They are routine maintenance. And in such an environment, hard assets don't need hype. They need time. Time allows ratios to compress. Time allows confidence to erode gradually. Time allows capital to rotate. When the shift begins, it rarely looks dramatic at first. It looks like a steady climb in gold. A few strong weeks in silver, then consolidation, then another leg higher, then headlines start catching up. Late in the cycle, acceleration happens. That's when the public notices. That's when disbelief turns into urgency. That's when silver historically stops behaving politely. The timeline matters, not because anyone can predict exact dates, but because cycles tend to echo. Past equity to gold extremes took years to fully unwind. Precious metals peaks arrived after prolonged buildups, not overnight shocks. If the current cycle resembles past long bull phases in hard assets, the move would likely take years to mature. That's not discouraging, that's stabilizing. It reduces the need for fantasy. It grounds the projection in precedent. The key idea is not tomorrow, it is trajectory. A 4-digit silver price does not require chaos. It requires revaluation. It requires a long-term shift in how assets are priced relative to each other. When people say it sounds crazy, they're often reacting to the absolute number. But absolute numbers are deceptive in an era of currency expansion. What matters is purchasing power and ratios. If purchasing power declines steadily over a decade, asset prices measured in that currency will naturally rise. The question is, which assets rise faster? Silver's volatility becomes an advantage in late-stage cycles. Its smaller market size becomes fuel. Its industrial demand adds structural tightness. Its monetary history adds narrative gravity. Two forces stronger than one. That's the essence of the thesis. If equity valuations relative to gold compress meaningfully, and if gold's valuation relative to silver compresses meaningfully, the combined effect is not incremental. It's exponential. But here's the critical discipline: focusing on the middle of the move. Trying to time perfect tops and bottoms increases risk. Waiting for an exact historical repeat invites disappointment. Cycles rhyme, they do not copy. Targeting the center of the swing reduces emotional error. It acknowledges uncertainty while respecting structure. Right now, the broader system rests on high leverage and expanding balance sheets. Equity markets reflect optimism that growth can outpace obligations. Precious metals reflect skepticism that purchasing power will remain stable. When those opposing beliefs shift even slightly, ratios move. And when ratios move from one extreme toward another, the repricing can feel shocking to those who only watch daily candles. But to those who zoomed out, it feels inevitable. This isn't about hype, it's about compression and release. It's about psychology embedded in numbers. Silver does not need to be worshipped, it needs to be understood in context. The context is debt cycles, currency cycles, valuation cycles, confidence cycles. Stretch your time horizon and the improbable becomes plausible. Stretch it further and the plausible becomes probable. The greatest mistake investors make is anchoring to the present as if it were permanent. They assume today's ratios represent equilibrium. History shows equilibrium shifts. Silver at 3 digits once sounded impossible, until it wasn't. Silver at 4 digits sounds impossible today. But impossibility in markets often means not yet, not never. The roadmap is not a straight line. It will include pullbacks. It will include doubt. It will include periods where nothing seems to happen. But if the structural forces align, expanding debt, persistent currency erosion, equity to gold compression, gold to silver compression, then the mathematics compound quietly in the background. By the time the majority believes it, most of the move is usually complete. So the real question isn't whether silver can reach a dramatic number. The real question is whether the underlying ratios can swing from one extreme to another over the next decade. If they can, then the price becomes a consequence. And consequences in markets are rarely polite. This is not about predicting next week. It is about recognizing long arcs. Because when long arcs bend, they bend hard. And silver, historically, does not whisper at the end of a cycle. It roars. Now let's go deeper. Because price targets by themselves mean nothing without pressure. And pressure is building in places most people aren't watching. Silver is not just a monetary metal. It is an industrial input woven into modern infrastructure. It sits inside energy systems, electronics, medical technology, defense components, and emerging manufacturing processes. Unlike purely monetary assets, silver gets consumed. It gets dispersed. It gets locked into products that are not economically viable to recycle at scale. That matters, because when an asset is both monetary and industrial, it behaves differently in late-stage cycles. It doesn't just respond to fear, it responds to demand from two directions at once. On one side, you have monetary demand driven by loss of confidence, currency dilution, and asset reallocation. On the other side, you have structural industrial demand that doesn't care about headlines. It cares about supply chains. When those two forces align, price elasticity becomes extreme. The world today is heavily financialized. Most capital flows into paper instruments, derivatives, exchange-traded products, synthetic exposure, leverage layered on leverage. But silver's physical market is small relative to global capital pools. That imbalance is critical. It means that even a small rotation out of overvalued financial assets into tangible stores of value can overwhelm available supply. Markets at equilibrium absorb flows smoothly. Markets at imbalance react violently. For years, silver has existed in a suppressed psychological state. It has been perceived as volatile, unreliable, secondary. That perception keeps capital cautious. It keeps allocation low. But perception can flip faster than fundamentals. When momentum builds, narratives change. When narratives change, capital flows follow. And because silver's market depth is thin compared to global equities or sovereign debt, inflows do not trickle, they surge. Consider the macro backdrop. Governments worldwide continue operating with structural deficits. Debt servicing costs rise as interest rates fluctuate. Central banks navigate between tightening to defend currencies and easing to stabilize growth. Every move creates tension. Long-term debt either gets reduced through deflationary contraction or diluted through inflationary expansion. Historically, the latter has been politically easier. If inflation remains persistent over years, not necessarily explosive, but persistent, purchasing power erodes quietly. Savers begin seeking assets that historically preserved value during such periods. Gold tends to move first. It is larger, more liquid, more widely recognized as a reserve asset. It climbs steadily. Institutions allocate, central banks accumulate, silver lags early. It builds a base. It frustrates impatient participants. Then the ratio compresses. When gold's move becomes widely accepted, attention shifts to relative value. Silver appears undervalued compared to gold. Speculative capital notices, industrial buyers hedge more aggressively, retail interest rises. Because silver is smaller, the same dollar inflow creates a larger percentage impact. Late cycle acceleration is rarely smooth. It is characterized by sharp rallies, violent pullbacks, volatility spikes. Headlines call it mania. Critics call it irrational. But structurally, it is the release of long-term compression. There is also the supply side. Mining production does not respond instantly to higher prices. It takes years to discover, permit, finance, and build new mines. Environmental regulations, geopolitical instability, and rising extraction costs further complicate expansion. Much silver production is a byproduct of mining other metals. That means output is partially dependent on the economics of unrelated commodities. Even if silver prices rise, supply cannot immediately scale if primary production isn't dominant. Meanwhile, above-ground inventories are not infinite. Strategic stockpiles have been drawn down over decades. Industrial users do not typically hoard large reserves, they rely on steady flow. If investment demand increases meaningfully during a period of tight physical supply, price must adjust to ration availability. Price is not just a number, it is a balancing mechanism. Now layer psychology on top of structural tightness. Markets move through stages: disbelief, awareness, participation, euphoria. In disbelief, rallies are sold. In awareness, dips are bought cautiously. In participation, momentum attracts momentum. In euphoria, logic is abandoned. Silver's historical peaks have often occurred during compressed timeframes at the end of longer bull markets. The move feels sudden, but it was built on years of groundwork. The critical shift occurs when the broader public no longer debates whether the move is real. They assume continuation. If we project several years forward into an environment of persistent debt expansion, ongoing currency dilution, and increasing geopolitical fragmentation, hard assets gain narrative strength. Currency confidence is subtle. It erodes slowly, then all at once in perception. People do not wake up one morning and decide paper has failed. They gradually allocate away from it. A decade-long horizon changes the math dramatically. Imagine gold steadily repricing over years as central banks diversify reserves and private capital hedges systemic risk. Imagine the gold-to-silver ratio compressing as speculative and industrial flows converge. Imagine supply responding too slowly to sudden demand shifts. Four-digit silver no longer requires hyperinflation. It requires compounded repricing. The most important factor is patience. Short-term traders chase volatility. Long-term cycles reward positioning before recognition. If silver were to approach extreme valuations relative to currency, it would not happen in a vacuum. It would coincide with broader asset realignments. Equity markets relative to hard assets would compress. Debt markets would adjust to higher real yields or ongoing inflation pressure. The key ratio between equity valuations and gold historically swings from extreme optimism to extreme pessimism. If that compression unfolds again over several years, gold could multiply even without stock markets collapsing outright. It only requires relative outperformance. Combine that with a gold to silver ratio that tightens toward historical mid-cycle levels, and the multiplication effect compounds. Mathematics does not care about disbelief. If one variable triples and another variable triples relative to it, the downstream effect can be exponential. But timing remains uncertain. Cycles can stretch longer than expected. Policy interventions can delay adjustments. Markets can remain irrational longer than conviction remains solvent. That is why focusing on the middle of the move matters more than predicting the peak. The middle is where probability and risk intersect favorably. The middle is where structural pressure is visible, but euphoria has not yet overtaken logic. We are potentially in the early to middle innings of a long repricing cycle in tangible assets. That does not guarantee a specific outcome. It suggests asymmetry. The asymmetry lies in the scale difference between global capital pools and the silver market. It lies in persistent fiscal expansion. It lies in industrial demand growth intersecting with limited new supply. If a tipping point arrives, whether triggered by monetary policy miscalculation, geopolitical fragmentation, or simple momentum, silver's response could be nonlinear. Nonlinear moves feel unbelievable before they happen. They feel obvious afterward. The question is not whether volatility will occur. It is whether structural forces align long enough to sustain repricing. If debt continues expanding faster than productive output, if currency purchasing power continues declining over time, if capital begins rotating away from purely financial assets toward tangible stores of value, if supply constraints prevent rapid scaling, then silver's path upward becomes less about speculation and more about adjustment. Adjustment to new ratios, adjustment to new confidence levels, adjustment to a different perception of value. And when adjustment compounds over years, numbers that once sounded absurd become milestones. The disbelief you feel today is similar to disbelief felt in past cycles before major moves unfolded. Cycles do not repeat perfectly, but human psychology does. Underestimate silver long enough, and when it finally moves, it moves fast. Not because it is magical, because it was compressed. And compressed systems, when released, accelerate. You won't believe what silver's about to do. Not because it defies logic, but because most people are measuring it with a ruler that's too short. Stretch the timeline, watch the ratios, follow the pressure building beneath the surface. If the structural forces continue aligning over the coming years, the move won't be a headline surprise. It will be the inevitable result of mathematics, psychology, and imbalance converging at the same time. And when that convergence happens, silver won't ask for permission to reprice. It will simply do what cycles have always done, swing from one extreme to the other, leaving disbelief behind in its wake.